What's up, everybody? Michael Silva here, and COCO. Look who wanted to come say hello. You're watching the Daily Stock Market Brief, the show that I do Monday through Friday, 5 days a week. We use technical analysis and intermarket analysis to get a good idea as to where the market might be heading next. Today, obviously, we saw a big bullish day, and we didn't predict it, but we did see some market internals suggesting that a rally like this would be taking place from a seasonality perspective going into April, and also from just overextensions to the downside. But the question on everyone's mind is this the fake out or the beginning of a larger move to the upside? So we're going to be looking at a lot of charts today to really kind of help us see the bigger picture of what is going on. So with all that said, let's just go ahead and hop into today's show. Whee! Hey, what's up? It's me again. I just don't have a camera on. And I just cracked myself up a sparkling water blueberry pomegranate. My wife buys these at like Whole Foods for like $4 a piece. And I get mad at her every single time. And then I drink them all the time. All right, let's get into the show. Thank you for joining me today. We're looking at the market dashboard right now, an overall look at the market and the market sectors. What was doing good? Well, we see consumer discretionary up there at the top, technology and utilities. Kind of interesting mix right there, especially having utilities, a more risk-off type play coming in at third for the day. So this could be temporary, might head down lower, but consumer discretionary and technology did make the lead today, and you can just see that as the Qs really started taking off. The Nasdaq here up 3.69% for the day, so just a monster bullish day. Now, if you don't follow me on Twitter, follow me there, because every once in a while, if I forget something in the daily market brief, I'll just post it on Twitter. Like today, I posted a bunch of different chart setups that look pretty good for the most part, and they make for a good risk versus reward trade. But I posted this yesterday, right after I posted the market brief, and really what I wanted to just call out here was, I said some volume patterns I'm seeing in the Qs have me feeling quite confident that an April seasonality is going to play out. Nothing is certain, but I'll be prepared if we do bounce, and we definitely got a bounce today. Whether we get follow through on that bounce is yet to be seen, but I want to show you kind of what I was looking at. So first off, this right here down here, this indicator is volume. And I spread it out on a 10-day moving average so you can see volume spikes. And when we get these large spikes in these high ranges, you can see that that's typically a short-term bottom or a bottom in the market. So you can see these spikes above the blue horizontal line here. That presented itself a nice rally follow through right here as well, here before heading down lower, right here as well. So this isn't to say that this is the market bottom, but it could be very well a short-term bottom before it starts leveling itself out. You can see here, this was the March bottom. It really overextended. So this doesn't mean that it can't go higher, but I just wanted to call it out that we are getting into these large, volume ranges, especially from a 10-day moving average perspective, which could represent, a short-term bottom. And we really saw that follow through today. And, what really drove that? Well, when you look at the 10-year yields, okay, we look at intermarket analysis here. If you're new here, we look at, bonds, dollars, stocks, indices to get a good picture overall. So the yield, we've been watching the 10-year, and the higher this goes, tech gets pressure to the downside. You can see this correlation take place. And really, why I've been saying I wouldn't short tech here just because of these overextensions in the 10-year yield. All right, so you can see it's really overextended, overbought here on the RSI, and we saw a little bit of a down move today, not by a crazy amount, but we did see it go down, and that helped fuel the tech rally. Now, there's also other things involved in that, but I want to call out the overall picture here too as well. We're really coming off of some pretty overextended areas, and we might see these temporary rallies, but you got to also keep in the back of your mind that these rallies, huge rallies to the upside, typically take place during market tops and bear markets. So when you see these aggressive moves to the upside and then, large range candles and all this drama and all this emotion, you don't want to you got to be very, very careful. And this right here is the Dow Jones Global Index, and you can see from this perspective, this price percent oscillator looking at the components of 1, 10, this means that, you know, we're pretty extended from the 10-period monthly moving average here, and we're up at the top range of this channel. So it would make sense on a negative divergence in these overextended areas that we see moves to the downside, especially while we're trading at the upper Bollinger Band. But, you know, markets can stay overextended for quite some time. You just gotta have this in your, you know, you don't want to be shocked if the market corrects itself and this is just a temporary move. You need to be prepared and be aware of what's actually taking place in these big indices. Now, here's the BKX. As the 10-year drops, that's not good for financials. So you saw financials get hit today, right? So if you look at the sector board, where was financials? They were just right above energy, so they didn't do too good. And we call this little line here the red zone. This is resistance, and this is a big-time picture, right? So the monthly perspective. But every time it reaches up into these resistance areas, it hasn't broke through yet. Now, mind you, it was reaching up into these areas, and then rates were slammed down to zero, and then we recovered. And as soon as we started quantitative tightening, you know, when we came up into this range, they fell down again, and then this was the pandemic drop. Now we're already reaching back up to this red resistance line at the interest rates, the Fed funds rate, at basically zero here. So these times, when it hit, it wasn't at quite zero. So this is a big area of resistance here. We have a negative divergence on the RSI, negative divergence on the MACD, and the financials, the KBW Bank Index is, you know, the largest 24 institutions. This is just, and there's also a regional one. I think it's called the KRE. I can't remember the ticker for it, but you know, if this falls, you have some serious pressure on the equities markets as well. And this is one big overextended move. And, you know, the monthly close has to get above this and maybe stay up there for a couple of months or a couple daily closes to turn this resistance into an area of support. So we're right there. We, you know, cracked that high, but we're not, you know, for sure if we're going to be closing above that. We tried in last month in February, you can see that wick, but then it came right back down, and now we had a big green candle, and now we're starting to see it have an upper wick too. So we got to keep an eye on that one, because if this is a topping for this is also a pretty overextended move. And you look at yields, the 10-year and the 30-year, you can see these aggressive moves to the upside. These are good for financials, but you gotta wonder, is the Fed going to step in? Are yields going to kind of take a breather right here? I would imagine that the 10-year yield would have to take somewhat of a breather here because of just this huge move very fast. And if it continues a huge move very fast, I think that's going to shake up the equity markets quite substantially, as we're seeing right now. You know, you're seeing a lot of drama in the markets. And by drama, I mean large range candles, okay? Not from open to close, but I'm looking from high to low, these large ranges. And we'll get into that here on the indices as we go through it forward. And you know, I'm doing this show a little bit different today. I typically break these out into sections, which I will, but I'm just going over the bonds, yields, dollars, and the banking stuff kind of right now, just to give you kind of good framework. And, you know, we said we had to hold, this is the dollar, by the way, the dollar and the S&P 500 below here. We said that we had to hold above 92 for a couple of days to really ensure that this was a solid move to the upside, because the overall trend, right, the long-term trend right now is still down. You can see the 200 period just trending down, but then you see the smaller moving averages, the 50, which is also a Godfather moving average, and the 20. Those are in a short-term, intermediate / term bullish to neutral, because they're kind of going sideways to slightly up. And as the price action stays above it, that means that these moving averages will continue to drag up here. So, you know, it's still not out of the woods yet. And this was kind of a little bit of a reversal day here. So if we get resistance up in this range and we start falling back down, or the Fed steps in and does something like Operation Twist or yield curve control, it's highly likely to see the dollar continue its projection to the downside, which can fuel equity markets, but it can also fuel commodities as well, which we've been seeing commodities really start to take off in recent months. And now, you know, some of them are taking a little bit of breathers. So there's a lot of things going on at play right now in the markets, and we're at these very critical levels. And we have people from both sides of the parties, okay? So I'm not here to say that I'm bullish, and I'm not here to say that I'm bearish. I'm here to just kind of trying to show you both perspectives, okay? We have very successful traders and investors and economists saying, one, this is the start of a bear market. But then we also have, on the other side, we have people saying that this is just the start of an even larger move to the upside, and then potentially this bubble can burst. But from both perspectives, I see, some people are saying it's bursting right now, but from both perspectives, they still all believe, for the most part, that this is just a bubble-fueled Fed rally. So yeah, it's just crazy times overall. Let's go into the indices. We're going to start off with the Wilshire composite, the 5,000 composite, big broad market index. Not out of the woods yet. Big day, right? 1.69% to the upside. Still a head and shoulders possibility pattern here. You see the price percent oscillator kind of moving up here. So this can be a bullish crossover, and we continue to move right on up to the upside, crack 42,000 and continue to move higher. But why I say we're not out of the woods yet is simply because the moving averages are still actually quite bearish. We came into the 20 period moving average and we got rejected. It's a strong bullish looking candle for the day, but we've seen these large range candles and we've seen big bullish days with big red days to follow. What I do find interesting is this horizontal dash line. That is the yearly open for 2021. And you can see we pulled back down right over here, and then we bounce from that area, and then we bounce from that area again. So it's just interesting overall. So we opened up right here. This is 2021. Okay, we came up, bounced right from that area, bounced from that area again. If we bounce from that area again, that would actually complete probably a head and shoulders pattern right here, as long as we crack through that neckline being the yearly open. So just a very interesting kind of play overall. What I do want to say is once we start getting back above the 20 period moving average, that's when these other moving averages could cross over. And the last time we've seen some moving average crossovers were right here. So right here we crossed down, that was bearish. But as soon as we had all of them cross above and we have the 5 stacked above the 10, stacked about the 20, we really saw some nice moves to the upside. You can see that here too. Nice move up to the upside, but it was flush back down. So, be on the lookout for that. That could signal a very, very good turn in the markets. Now let's look at the S&P 500. I had this megaphone descending, broadening wedge type pattern marked out here, still within that head and shoulders. So we're marking that. We're keeping an eye on it. We have that neckline right here. But this purple line here and this purple line here, that's somewhat of a technical pattern. You can see that it's holding a support here. So it's lower highs, lower lows. And we tried cracking through it today, but the market pushed it right back under. This could be the early signs that we do break out, but we haven't actually had confirmation on a breakout. I do think that if we capture that level and get above 3,900 on a daily close, it sets us up for 4,000. I think fairly easy, but we're not, like I said, out of the woods quite yet, just because we haven't, got out of this little resistance that we've been building. Overall, though, you gotta just look into this perspective. We have the 20 period sloping up, the 50 period, the 200, all sloping up, and you have higher lows being built. So there's nothing suggesting right now that this is a full-on breakdown moment. It could be, but there's nothing suggesting and giving confirmation to it. Another thing I want to note here is the price percent oscillator is kind of turning itself up right here. That could signal a bullish crossover and the start of another potential trend. As you can see, we had these bullish crossover here. Boom, that was on a big down move, and then we moved up. We had one here, and you can see it followed through with some pretty significant moves up. If that is the case, we can play to that seasonality script that we talked about yesterday, where April, we really start seeing some big moves. Here's the 30-minute time frame. Just want to kind of show you this zoomed in of this descending broadening wedge. You can see the stair steps going down, so we haven't really broke through that. We had the stair step right here, but we still have to take out this swing high, really to kind of suggest that this is possibly corrective move here. And that little trend line, that purple trend line that I had on the other slide, kind of goes right here. So if we start breaking above that, that can easily send us up to about 4,000, and that's why I've been saying that. All right, let's quickly take a look at the Dow Jones. You can see here somewhat of a shooting star type candle. We had an aggressive move to the upside. It was a very bullish day. Looked like we were going to be breaking out. We had that bullish crossover almost taking place here. It's more of like a bull kiss, but we don't know if it's actually going to have some follow through. And that 32,000 level did still continue to hold. as a level of resistance. We have that negative divergence right here that we pointed out. So this is a little confusing to me. It's going to be interesting to see what plays out tomorrow. But overall, this little candlestick pattern, if we start getting below 31,750, it's very, very likely that we go test the 31,500 and potentially move lower. So currently in this period of consolidation as well. And, we were here just a little while ago, as you can see here in, mid-February, we tried taking out that level 2 and we followed through to the downside. So this could be something very similar. So we got to be mindful of that. But overall, still higher lows, the moving averages, they're just trending nicely, just this solid river flowing to the upside. Yeah, we have all these gray boxes. If you're new here, you don't know what those are. Those are just me marking out gaps in the market, the overnight session. So there's been a lot of gaps, and gaps do matter. Gaps get filled for the most part, not all of them by any means, but when you see pockets of gaps like this is very, very irregular. So this is interesting times in the market, and I haven't seen anything quite like this. And you can go back through history and look for a pocket of gaps like this, and I have not been able to find anything like that. Nasdaq. Let's look at the Nasdaq here. We're looking at the Qs on the daily time frame. This was up almost 4%. So just crazy move. Look at this big red candle. We were talking about the market internals, how it looked like, this is weird. Like, we saw strength in the internals, but a big down day. Something doesn't line up here. And then bam, this huge gap up, and then just solid green day to the upside, closing above these previous candles. This could represent a, just a corrective move where we really start moving higher here. We've seen stuff like that take place. You can see it right here. In just 3 days, you move from 270 up to around 295. So, it's happened before. It could happen again. And we saw big moves right here too as well. That's not saying that this will happen, but this little, move to the upside and then pull down looks similar to this move up to the upside and then this pull down. So we might get something very similar to what we're seeing here. But like I said, we're right around that 38.2 fib level. We still have these higher lows here up until just recently. So short term, this pullback, this correction, is typical to see in the markets, but we haven't had any moving averages cross over themselves. So it's still really within this bullish context. We marked out this pink box, if you're wondering. That was a target, a week ago or something like that, or a few days ago. I can't remember. But we clearly pulled right into that move, that target, and we've been bouncing from that area. So now we got to see if we can get some more force to the upside. But keep in mind, we had that 50-period moving average as an area of resistance and the 20 period still. And the longer we hold down here, the more likely it is to see the 20 period cross under the 50. And, this right here, this breakdown, this could be the back test to the neckline of the head and shoulders pattern. So tomorrow is a very important day to see if we start closing back above this. That means that this head and shoulders could be just one big bear trap where people shorted, or started getting out of positions, and then they might miss out on just one monster rally. So that's a bullish viewpoint on it. However, from a bearish standpoint, like I've said, you get big rallies on corrective moves. And this could be just one of those rallies for the next leg lower. So we got to be very mindful. You can see a stair step here, a stair step here, and now this could be potentially another stair step to potentially move lower. So we have a low here, a lower low. Maybe perhaps we take out 61.8 and come all the way down to this 275 range, which we've been talking about. That would be the full correction of a head and shoulders kind of breakdown. That would be that target zone there. So we haven't done it yet, but we'll be keeping a close eye on it. Moving forward, here's the Qs on the 30-minute time frame. You can see the stair step stepping down. Still, this trend line right here is an area of resistance. We need to we need to take that back, and we need to stay above the 50 period. We need to have the 50 period moving average as blue line cross above the red line. That right there would be, a short-term golden cross. Doesn't technically mean anything too much, but it does put us back into more of a bullish context. As you can see, we have the lower highs, the lower lows. We need to take out this previous high and then continue to make a new high, a higher high, and a higher low, which would just shift the trend from this short-term bearish to more of a short-term bullish and follow back along to the long-term bullish trend that we have been in. Russell 2000, we're going to look at the IWM here. First off, price percent oscillator is trending itself up. It's trying to curl itself over. That can result in a bullish crossover. We see the histogram kind of turning up there too. Back above the 20 period moving average, so we're still trending very strong here overall. You can see this big hammer candle did have some follow through, but we're still within a channel. Okay, so we need to, if we want to see this trend continue, we need to crack above 230, and then we could see some follow through at that point, and that could really result in even more of a melt up than we've already been seeing. Or we're going to start breaking down through this 205 area, and that right there could be also a potential head and shoulders pattern, right? We see this shoulder, head, if this doesn't reach back up to 230, this can kind of curl itself over and create another shoulder. So that's always a possibility right here. But as we see here in the last 3 days, we've been seeing quite a bit of strength from a low of 205 trading all the way to 225 or a high of 224.99 exactly. So overall, you know, a nice bullish bounce off this neckline right here, or this little area support at 205, but we're still in this channel. Here is the IWM on the 30-minute time frame. And, you know, if you don't follow me on Twitter, like I said, you can follow me on Twitter, but I posted here when we were running into this area of resistance saying, hey, we're back up at resistance again. And I don't know if that was for the SPY or if it was for IWM. I can't remember what I posted for, but both the SPY and the IWM look very similar like this here on the 30-minute time frames. But I wanted to call out this. So we have this pink line here, pink line. These are these stair steps down. So we're putting in lower highs. And every time we reach up at this area of resistance, we put in a new lower low. So you can see here, boom, to the downside. Boom, right here, a lower low, here, a lower low. So are we going to see a continuation here or something going to change in this momentum? If we do continue to head lower, that means we're going to be taking out 207 to create that new lower low. So this could be the very top of, you know, this corrective type of move to the downside. However, if we start breaking above the 225, that could suggest that we really have room to scream higher to all-time highs. Okay, so we got to just keep an eye on this support and these resistance levels, because right now we're just channeling during this chop, and we have, you know, more momentum potentially heading into April based off that seasonality perspective. Let's look at some stock market indicators. I want to show the CPC. This thing continues to scream higher here. As you can see, we've had another spike to the upside. This follow through the red line. Keep in mind, remember, when it crosses above that, that's that sell signal. We don't know how much a sell-off could take place, okay? But as you can see, when it hit 0.8, we saw all this emotion and all this drama in the markets, and we pulled down a little bit. And we've seen it before where it crosses above like this, and then it goes, you know, down, up a little bit, but then we have more of a corrective move to the downside. So keep in mind, this can still suggest that we have more downwards pressure to come, or potentially, like I said, that could have been the sell-off right there where we just saw these multi-day large range candles, these, you know, very short-term sell-offs. Now, sometimes a buy signal can be when it crosses above the green line, that 0.95. and then crosses back below down it. So for example, here when it crossed above and it crossed down, you can see that was right around here, and then it started moving up, and then we've had, you know, over here too as well, across down below it. I don't really like to use that as much personally, but it is something that we'll continue to track and kind of watch out for. But just notice that it is still trending up here, which suggests that the sell signal could still very well be on at this particular point in time. And from a VIX perspective, we're still, like, notice just how many days we're clunked around this 25. So volatility is still relatively high. The fear index, you know, the VIX, right, is still relatively high. I wanted to call out this trend line here. This seems to be building up some support. If we crack below that, I think the market's set to either fill this gap right here back at 20, and even potentially this gap that's been bugging me for now over a year from the February crash. And remember, gaps can act as support sometimes. So if we crack below that, the market could continue to scream, even potentially reach to 4,000 plus. You know, there's a very strong possibility, but keep in mind, when we reach these levels, it's always a good idea to start really kind of being cautious, because if we bounce again, we've bounced a few times from these levels that resulted in the S&P 500 taking some drawdown. So you want to make sure you're pocketing profits during those times. And if we get continued spike to the upside, we're going to be looking at 32.5 and this 37.5 range to potentially put on more positions to the long side, because that could very well represent a top for the VIX, which means that we might have a short-term bottom in whatever asset that we are trading. So we got to also monitor that. But as it stands right now, we're still here trending around this support. So we're looking for a crack back above 25 to get to 30, or we're looking for a crack below this area of support to fill some gaps. Till then, it's just really going sideways with some monster chop back and forth. Spring bottom fisher, there's nothing going on here. We had this crossover here, which could represent, moving into more of the winter months, or month or day or week or whatever. Sometimes when we have these crossovers where the blue crosses below the green line, we see some sell-offs take place. We had that little sell-off here, so it was somewhat accurate. But this one's really good at finding market bottoms, as you can see when it crosses below the green line here, and then the blue line crosses above the green line. It tags market bottoms, not like perfectly to a T. We use the Cohan also for that. We got to use multiple indicators to really kind of help us. What just happened? Oh, okay, there we go. To really help us find those market bottoms. But you can see that this has worked very well here in recent market drawdowns. And then we have the breadth indicator. This is understanding market breadth, and I like to use this, the NYMO, the Nyersey-McClellan oscillator, to find overextended moves and also divergences. So we had a negative divergence here, negative divergence here. This one led to a bigger sell-off. That was the pandemic, but it's also been used before to find other sell-offs. And then we see some very similar price action in 2021, just like we did here, and we're starting to see that sell-off take place. Now, we don't know if this is a short-term move, but if we get, if we stay at these ranges, this minus 60, that offers up good bounce opportunities. If our breadth gets above this and starts heading up into this, 60 to 80 range, that's a good opportunity to take profits, because sometimes when it has these big burst moves, we see downside movements, as you can see right here, bam, to the downside. Not always, but it does, like right here too. This was right around here, but then we had a little move to the downside. So we'll keep an eye on these overextended areas. Breadth overall, minus 2.54. So, up from yesterday, but still a negative breadth. Interesting stuff. Negative breadth with a nice day in the markets too, which is also odd. Here's the BP NDX. I use this to just kind of look at also overextended moves to the downside. So we called out this. This is why I was saying that we shouldn't short the Qs right here, is because there was showing strength in the internals. So we had this positive divergence here on the BP NDX RSI, and we saw the lower low here. So what do you know? We're oversold. The market moved to the upside pretty significantly today, and it still has room to shoot higher just based off of this chart. Or potentially it's just shaking it out a little bit before we head back correctively to a lower RSI reading again. That's happened before too, so we got to be mindful of that. But as it stands right here, the positive divergence is still in play. And then we had the BP INDU. We called it right when it hit this oversold territory, and we've seen the Dow Jones now crack to an all-time new high as of recently, or reached to all-time record highs. It didn't close there, but it hit there. Now let's get into some commodities. Gold had a really good day today. Yesterday's video, we called out that sometimes when we get, pretty significant drawdowns past the 200 period moving average. So for example, here was a 10% drawdown below the 200, and then we called out here. So 11, 8, 10, 9. They've all resulted in some pretty significant rallies. And today we had a pretty significant rally. You can see here on this chart, this was that buy zone that I was talking about, this pink box there, as we were pulling into this green line, which is an area of support. We said that I had to hold. So we've reached down to the bottom end of this channel, the buy zone, this green area of support. I said this makes sense from a confluence supports standpoint, and we had oversold readings on the RSI. It made sense for it to bounce, and today up 2.32%, $38. But keep in mind the overall trend still down. We still have lower lows, lower highs, but this could be potentially a start to reach back to the upper end of this channel, maybe potentially break out, but we got to be mindful too that we still or, you know, we could still potentially have a bull trap here. As you can see, that looked like a solid breakout, but then bam to the downside. So we got fooled there. Oh, the bulls got fooled at least. And if you're keeping an eye on the 10-year yield, by the way, the 10-year yield, as it rises, we've been seeing this act in correlation too. So the 10-year yield, actually, let's just go back to that chart. So the 10-year yield bottomed out right here in August. Okay, see that little hammer candle and then plow to the upside? Well, let's look at what gold was doing during August right there. Bam. So you can see that as the 10-year yield bottomed, gold topped out right here, and the 10-year yield continued to move forward, and the gold started continuing to put in lower highs. So perhaps if the yields do head lower or start taking a breath here, that could shoot gold higher as well, especially if you tie that in with the possibility of the dollar continuing to fall. That can really fuel gold, silver, potentially even Bitcoin, which we'll get into here soon. Silver right here broke down out of this trend line. This could be a bear trap. We're not out of the woods yet, still below the 50-period moving average and the 50% retracement level, but I will say this is a pretty strong day, so if we get some continued follow through, that could suggest that we do have a lot more upside potential here in silver. We've been keeping an eye on the rate of change right here. I just used the 12-period. I did notice that positive divergence, and I was tracking that in recent videos as it moved into the 61.8 retracement level. So it almost seemed like a bounce of some sort was going to take place, and that, you know, I don't know how much the bounce could be, but that was the start of a bounce. And if we get follow through, that could suggest some good stuff for silver. WTIC, this was that horizontal line of support that we drew out, 64. We closed at 64.01. I'm thinking that if we close below that, it's an easy shot down to, you know, 60. You know, that'd be that next area, 60 to 6. Yeah, I would just call it 60 would be the next potential area for support. This has just been on a monster run, negative divergence. Needs to take a little bit of a breath. I know that there was some stuff going on with crude oil overseas. I can't, you know, I'm not by any means a professional oil trader. It's a whole different ball game. But there was some sort of some bombings or some sort of attacking, and that, you know, was the other day, and we saw a big green day to the upside, and as soon as that kind of news came out, we started seeing it pull back, and you know, the possibility for continuation of that is very likely, but the technicals here suggested a pullback anyway, as we've been tracking as of recent. So we'll keep an eye on this. If it's still in an uptrend, so if we get a pullback, that's healthy. You want to look for these solid opportunities to buy. If we get back into the 50-period moving average, I'd be looking at a lot of energy stocks to start going long in, because that could set up for some really good rallies. And then the last chart that I want to talk about is BTC, Bitcoin, right? This red area of resistance, what did we say? When it cracks above 52.5, easy shot to 57.5, and we're starting to see that move now. We have the bullish crossover. This right now looks like it has a lot more room to go. So, you know, if you're long right now, it's probably, you know, it looks good to me. Right, so it's just a solid setup overall. I like how this is crossing over. I like the breakout of this resistance. To me, that's just, I just really like this chart right now. Overall, very bullish context. And like I said, the next takeout is 57.5. So congratulations who is holding or bought on that breakout. Hopefully we get that continuation. Always keep in mind, right, it could be an area of resistance, right? And that, or if it heads a little bit higher, we might have a negative divergence. So you got to always be mindful of the bearish angle and be mindful of the bullish. You don't want to get too hyped on, you know, being a bull or too hyped on being a bear, because if you're not willing to adapt and if you're not willing to change or see another perspective, you're going to be stuck in a one-sided trade that can result in potentially over-leveraged position and a loss of a lot of money if you fail to, you know, exit that position. So just a couple food for thought. So yes, conclusion. We talked about a lot today. Really, I hope I kind of drew out a big picture from both a bullish perspective and a bearish perspective to understand, you know, why I kind of saw this bounce coming and where we could potentially see it go if we crack through these areas of resistance, these descending, broadening wedge patterns, right? If we break through those, it looks like the market can really start to scream up to all-time highs again, but we're not there yet, so we're not out of the woods. It looked like a solid day. It could very well have some follow-through just by how everything's set up. I think we need to see the 10-year yield take a breather or head down, and we need to see the dollar continue its corrective move to the downside back under 92 to really see this take place. And that's what happened today. And we saw, some strong benefits come from it. So that's all I got for you on today's market brief. Hope everybody enjoyed it. Smash that thumbs up, and I will see you back here on the next episode. Ta-ta.